Good evening. I have decided to record this lecture for the first part of this syllabus, the overview of finance or the overview of financial management in order to catch up those days that I have went on emergency leave so that we can finish this our discussion on time because we have started quite late already. So we have to, as I have said, every time there are suspension of classes for any reason, we have to catch up by presenting through video presentation. So I'm not exempted. So therefore, I have decided to record this discussion for my part in the syllabus, so that after this we'll just be having a quiz, and then it's your turn. Maybe next meeting it would be the turn of the first group in the presentation right after the quiz that I'm going to administer. So our lesson for tonight is the overview of financial management. So the first one, or the first in the list in our topic, is the definition of finance. So in the book, it used the definition by Webster's dictionary, and it says finance is the system that includes the circulation of money, the granting of credit, the making of investments, and the provision of banking facilities. If we are going to look at the definition used by Webster, we would say that it is limiting only to those four that have been discussed, namely granting circulation of money. When we say circulation of money, this is the role of the central bank, or in the Philippines, our BSP, in the US, it's a federal bank. It is their role to expand or to contract the money in the circulation, or the volume of money in the circulation. In other words, they have the control of the volume or the number of pieces of bills or the paper money circulated in the economy. So when there are inflationary movement, like the inflation is going high, they will have to decide to contract the money, or if the inflation is low, or they have um to decide on activating the investments, they have to expand the circulation of money. And basically, this has something to do also with the stabilization of prices of commodity. Now, the next one that the definition has mentioned is the granting of credit. So we know that the fuel of businesses is almost through the credit. And we know that the most provider of credit are the banking institutions. But in the micro level, we know that there are lots of credit management to be done in order to protect the risk, or in order to protect the company from the risk of these credit activities. Now, when we say credit management or credit activities, we would we would say that two uh, there are two instances when we are uh, providing credit or when we are incurring credit. It is almost or it is unavoidable a company will have to resort to credit. There are two forms. One is that we have the deliberate move to obtain credit, and the other one is that it is spontaneous. We'll tackle first the deliberate move. When we say deliberate move to obtain credit, is either the government or a corporation or private entity, they will have to go out of their way to apply for loans. And by that, either short term or long term, they have to obtain that credit according to their fund needs for their operation. The other one is inevitable. When we say spontaneous credit, those are part of the day-to-day operations of the business because they are happening naturally. Like for instance, if we are going to make use of human resource, we, without knowing it, is being indebted, and we call that accrued expenses, wherein we enjoy today and we are enjoying now the services or the the services, and then we have to pay later. The same is true uh with the power the electricity that we are using, the water that we are using. They are being enjoyed today, and after the end of the period, we have to pay for them. So by that, we what? We incur credit spontaneously, and that is part of the business. Another thing is that it is inevitable also for those companies or suppliers, especially if they are into competition, that they have to give or to provide commodities to their customer on account. That is why in our financial statement there is an account called accounts payable, and this is part of the spontaneous credit that we obtain out of natural case of course sorry out of the natural course of the business. So there's a lot of credit management to be done in finance. Another one is the making of investment. So when we say when we say investment, it pertains to what? It pertains to um, putting or parting of our money in our aim to have it grown or to earn profit from it. So the business itself is an investment. People are investing, the incorporators are investing in the company because they want in return profit. So meaning we really have to make management of investment so that we would have to avoid the losses. Money is subject of investment. So if ever the company has uh, idle funds or money that are not being utilized in the business, they should have to invest it somewhere else, like in stocks, in uh, in purchasing bonds and other forms of investments, because an idle funds will just be sleeping. It will not have an opportunity to earn if we do not invest them. If you have like building and you do not utilize those building, it would just be incurring losses for the company, because you have to maintain it and you have to pay taxes for real property tax for that. So therefore, you have to make use of that idle building by having it leased out or rented out, so that you will be earning from it. So a lot of investment management happening in finance. Another thing is the provision of banking facilities. A lot of banking services can be found in the bank, aside from the normal acceptance of deposit. We're going to uh, put the money of the company. They also have facilities like transferring of funds, remitting of funds to your creditors, or if you are importing something, you can make use of their letters of credit facilities in order for them to facilitate the the settlement of your obligation to your suppliers abroad. And in the case of of commercial banking, they have the sole power to create demand deposit, or that checking account that your parents know, so that this checking account becomes a large source of circulating, or large part of circulating money in the economy, because the legitimate business, they have to settle obligations, settle the transactions with the use of checks. And seldom are those businesses, not seldom, but none of those businesses that are transacting, exchanging transaction with the use of cold cash, because only the illicit transactions would be needing to make use of cold cash, like the kidnappers for the ransom, the drug lords, etc. So the exchange of transactions would be through the use of cold cash. And being so, that is the sole power of the commercial banks. And other facilities like loans, like consumer loans, business loans, and so on and so forth, are done by banking facilities. So those basically are activities as Webster's defined finance. But if we would we would look at those activities, or those activities defined or used in the definition by Webster, we would realize that it is limiting in the sense that you would only think of those four in order you would only look at those four as the functions and activities under finance. So that to make it encompassing, I would suggest that we have to define finance as the management of assets and liabilities. Now, management of assets and liabilities. In the liability side, be it in the government and in the corporate world, or even though the the sole proprietor companies, it is, as I've said a while ago, it is inevitable that the company incur liabilities. So, there are lots of activities on the side of managing the liabilities. And on the other side, the purpose or the aim of every company is to protect their assets, to manage their assets, and to what? And to have it grown. So the assets must be protected from losses, as well as it has to be um, it has to have a return or a turnover of a bigger profit. So there's a lot of activities happening there in the uh, management of assets. Now, if you look at the finance per se, it has two levels. One is the macro level, and the other one is the micro level. When we say macro level, we would find there the activities like banking, insurance, and even these things that are being done by the central bank or the central banking under their monetary policies. And also we can find even the fiscal policies being done by the government itself in their budget preparation up to their expenditure. They are all pertaining to finance activities. And we can also find in the macro level, aside from the insurance, we can find what the capital markets, or those that are investing in the stock market, so that um, there is a free flow of funds coming from the investors or from the savers, going to those users or the borrowers of money. Now, in the micro level, this pertains to those finance activities happening at the corporate level or at the business level, whatever the form of business. Is it a sole proprietorship? Is it partnership? Is it corporation? Or even, is it an association? Is it a cooperatives or anything? Or even the religious institutions they involve finance activities also. So under the corporate setup, there are two wings. The left wings, we can call it controllership. On the other hand, the right wing is the treasury management. Normally, the controllership is being done by accountant or CPA. Um, Within their jurisdiction would be the financial management per se, or the control of budget per se, the control of money, and also taxation, So those are some of their activities in the um, in the finance, under the finance. On the other hand, in the treasury management, these are what these are the process of uh, making the flow of funds, or the arrangement or the management of the flow of funds, banking relationship, risk management, insurance, and so on and so forth, to protect the assets as well as to gain profit out of the use of the assets. So these are the concerns of treasury management. Now, um, it so happened that the financial management is just an aspect of one of the aspects done by the CPA. But good thing is that if while the company is growing, or the company is getting bigger, finance people are not necessarily, or of those CPAs, because finance people, depending on your training in the school, they really are the ones who have managerial approach as far as the finance is concerned, while the CPAs, they are into technical approach in terms of recording, accounting, and so on and so forth. So yours, as finance major, you should have the skills of managing, or managing your assets, and where to put your money, and the cash flows of your money. Okay, now, what are the areas of finance? The book has identified three areas. One is financial management, which I've said usually uh, known to be undertaken by the CPAs, by the accountants. Number two is capital markets. The capital markets pertains to your investment in the stock market at the macro level, while at I'm sorry, at the micro level, while at the macro level, it pertains to the facilitation of this stock market, like brokering, underwriting, and so on and so forth. And the third that the book has identified is the investment. So when we say investment, as I've said a while ago, it pertains to um, parting off with your money, and with the expectation of bigger return. So we have a lot of uh, uh, activities in the investment, like the uh, analysis of different cases in the investment, and other functions. Now, the next one is finance within an organization. Finance in the organization will have to what? Will have to depend on the size of the corporation. Uh, Most of the smaller corporation, their trust is on the CPAs. Their trust are on the accountants. So when we say finance, it has to be handled by an accountant. But as we go bigger, larger corporations could be um, could be handled by uh, what could be handled by the finance people. And the name of the the name even the name of one handling the finance is different. Like for instance, those in the smaller companies, when they hire accountant, we call them accountant, and they're the ones who are also managing the finance. But in the larger corporation, they call it chief finance officer. And the chief finance officer, although preferably they hire the CPAs, but an experienced, a seasoned finance graduate is as good as those that are licensed, especially if that finance graduate has vast experience of managing assets and managing liabilities and assets. He could be a great decision maker in in the functions of finance, because no our basically your approach even here in the school is what um, managerial approach, as opposed to the technical approach of the CPA. So what do you expect to land as your first job? A lot in the corporate world, especially nowadays that there are in the Philippines we have this so-called shared services, wherein a multinational company would have their offices here in the Philippines, and they would hire finance people or graduated finance who would handle their accounts abroad. So they're doing it here, but their clients or their bosses are abroad, are located abroad, or their clients are located abroad, and they have to just communicate. However, before you could land to this kind of job opportunities, you must be good at the English communication. That's why I am always encouraging everyone through your lecture to make good at that and make it as a training ground for you to be able to become a good presenter of yourselves, of the idea of your reports, and so on and so forth, so that you would have a good chance of being hired in a uh, good paying job. And I seldom and nowadays I discourage my students in working in the local companies, because normally you would just be landing on companies that are giving lower salaries. Go for the multinationals that are found in the Philippines. You do not have to go abroad, so that you can have good chance of getting higher salaries. But your passport would be your communication skills in English. Okay. So I don't have to mention I don't have to mention what are those opportunities, because a lot could be enumerated in as far as the entry level positions are concerned. Now let us move on to the forms of business organization. I would like to emphasize, because there is another term that are interchangeably understood misunderstood for the forms of business organization. The other one is type of business organization or type of business. When we say type of business, do not say, when you're asked types of what are the types of business, do not say proprietorship, partnership, corporation. When we say types of business, it pertains to the activities they're doing. Like, are they in the manufacturing? Are they in the merchandising? Are they in the provision of services? Or um, are they in the mixture or the hybrid uh, business? Those are the types of the services. Now, in the forms of organization, we mean the basic three. One is the sole proprietorship, when it is owned by a single individual who who invest, who fund his own business. The second one is the partnership, when there are two or more, uh, up to maximum of five, are have agreed to put up business, and then they are what they are called partnership. When these partners agree, it doesn't have to be what it doesn't mean that they have to contribute equally. Sometimes they can contribute as they can afford. Sometimes one of them will be just contributing this managerial services in the case of an industrial partner, and some of them in the form of cash, some of them in the form of the asset that he would allow the partnership to use. And uh, of course, the expertise in the terms of in the case of managing partner, or the what you call this, the industrial partner. Now, the other one is the largest form is the corporation, when and there are at least five uh, incorporators decided to put up their business, and they decided um, to subscribe number of shares to the to fund the company's capitalization. Now, what are the disadvantages or advantages of this each of them? By the way, the corporation has a juridical personality, or it has an artificial personality, like that they are what they are like a person who can be sued or can sue, and it has its own identity. It's like a person with his own identity. Now let's go back to uh, sole proprietorship. When we say when we look at the proprietorship, they have both downside and advantage. The proprietorship is an advantageous in terms of the control, because you as a proprietor, as the owner of the company, you have the sole control. You have the control all over the business, and you do not have to get the go signal of anyone else, because it's all yours. You can manage, you are your own boss. But and also, whatever the profit of this company or your company, it's all yours. However, the downside is that you do not what there is only a limited opportunity, just in case you need more fundings. You have only limited opportunity to generate funds that will come up with a bigger operation, because you're only one. If you are going to if you are going to borrow from the banks, which will help also, but however, it would be dependent on the collateral that you will, or the asset that you will use as a collateral. And you would only have according to the Philippine setting, you only have 70% out of the assets that you are going to offer as collateral. So that's only the loanable amount. If you have only 1 million asset, therefore you have only 700,000 that can be borrowed from the bank. So that is so limiting. Therefore, you need someone else to help you in your business, and as it goes bigger, you have need for partnership. You approach another person whom you trust, and a call for a partnership. Okay, so when you're already in the partnership, that is an advantage, that you have now somebody to help you in funding your what in funding your operation. And if you lack expertise in that business that you have undertaken, you can look for a partner who is expert of that business, or expert in that business, and make him your industrial partner. So you have now opened higher possibilities of expanding your business. But then partnership has its downside also. Partnership, when one dies, the partnership is being dissolved, or if the other one withdraws, partnership will be dissolved. So therefore, this is the downside, because the life of the company uh, doesn't last as much as the proprietorship, or on the other hand, as that of the corporation. So as you go bigger, you are also needing higher or bigger funding, and partnership uh, will just give you so much, so that you now decide to incorporate your company by inviting investors who are willing to buy shares from your company. So you have to call for the incorporator, and therefore you have more chances of generating fund to finance your business. The the investors. Now, the investors or the original incorporators, um, they what? They have the downside for the corporation is that you have to relinquish your control to them. Before, when you were in the as a proprietor, a sole proprietor, you control everything, you own everything, and you enjoy the profit of everything. But as you go for partnership, you are going to relinquish your control over your partners. So do with the corporation, because now you will be sharing the ownership to other people. Let's say you start up with incorporators of five. So you will be sharing your your control over the five people depending on the number of shares that they own, and you as the original owner owns. So you have to make sure that your shares would still be the majority if you want to be um the major control, the major stockholders that has a major control over the company. So that's the downside of corporation. But then, as far as the generation of fund, we you have now the bigger chance of generating more for your for your operation. Now, corporation can be either closed corporation or public corporation. When we say closed corporation, the uh, the the stocks or the shares of stocks are only sold to the original incorporator. So it could not be sold to anyone else, but only confined within the original corporator. Maybe to some limited few, like for instance, one has relinquished his shares to another person, then it could be. But in the public corporation, your shares of stocks can be sold to other people outside of the original incorporator. Your stocks now can be bought by investors who will believe in your company. And there is a notion, another notion, that when we say public corporation, it has to be listed in the PSE, or those that are being traded in the stock market. Yeah, they are public corporation, but uh, they have to be listed. I mean, those corporation are those that are listed. They are also public corporation. So public corporation could either be listed or traded in the PSE or the Philippine Stock Exchange, or those that are only sold to investors, not necessarily um, listed in the PSE. So, what would be the downside? The advantage, another advantage of a corporation is that you have the what? It has the artificial being or its juridical personality, wherein if that corporation or that company is indebted and will come to the point that it could no longer liquidate, or it could no longer pay its loans or its obligation, the stockholders personal assets cannot be used for liquidation of its um, indebtedness. Only up to the liquidation would only up to the assets owned by the corporation itself. Unlike in the partnership, which is also a downside of which is, on the other hand, the downside of the partnership is that the creditors can run up to the uh, personal assets of the partners. Okay, so therefore, when it comes to liabilities, the corporation is more advantageous than those in the partnership, because of the fact that corporation has a limited liabilities. Although the the operation of the law, upon another authority, a partnership can be limited liability. Okay, so that a partnership, by the operation of the law, they could be a limited liabilities, by which partners will no longer be run after by those the creditors in the payment of their obligation. Now, what about in the taxation? In the corporation, in the corporation, the um, the company in itself is being taxed with uh, the income tax of the corporate itself. Um, and they have the proper terminologies for that. It could be corporate tax. Okay, so they're they're subjected to corporate tax, depending on the profit before tax of the company, or depending on the expenses and costs of the doing business, so that you will be the 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 stockholders is not subject to such income tax. But later, of course, when they receive their uh, their dividends, they will be taxed, but not as much as tax that is being levied from, in the case of the partnership, and in the case of sole proprietorship, because theirs will be taxed right away in their income, their profit, or their supposed profit or shares from the business, will be taxed right away as a income tax, an income tax. Okay, now let us move on to, I think, um, the next one is the main financial goal. The main financial goal pertains to what really is the purpose of managing finance. I have said a while ago that uh, there should be protection of the business assets as much as there should be a concern about the growth of the assets. Protection. When we say protection, because normally these assets are exposed to risk, so that when we have assets and it face the risk of losses, we have to do some management. Like for instance, you have the building, and you know that it is subject, or it could be open to some unexpected event, or the fortuitous event, like being raised by fire, or being damaged by earthquake, by typhoon, and so on and so forth. So to protect your asset, you have to do some risk management by having it insured, by having it financed. The losses will be financed by a third party, which is the insurance company. And if you have the cash, or you have the fund, or the cold cash, it has to be protected against inflation. It has to be protected when you are engaged in international trade. Like for instance, you are into importation and exportation. You have to protect its value by coming up with, or entering into forward contract or options. Later on, you will study about those terms: forward contract, options, and those are form of hedging the value of your money. If it is exposed to some inflationary uh, risk, wherein the value of your money will have to decline because of the inflation, then you have to do something by maybe putting it in money market, so that you can even break even with the interest that it may earn in the bank or somewhere else, or invest it somewhere else, wherein the return would have to be what will have to be more than the losses that because of the inflation. Now, those items, or those assets that are not being utilized directly in the business, it has to be invested so that the company would have the passive income, or yeah, the passive income, meaning they should be earning aside from the earnings that they get from the original, from the business itself, from the core business, so that the value is not only protected, the value is what? Increasing. The value of your asset is increasing. Now, in the course of doing the business, it is now the role of finance manager to support whatever the marketing department is what is recommending, or the programs of marketing department should be studied very well, because normally uh, because of the fact that the finance manager is into control of its funds, normally there is a conflict between the marketing department and the finance, because the marketing department is known to have an extravagant, say, marketing program or advertising program, and they would have to recommend a lot of extravagant uh, or costly program in order to maximize the opportunities of selling their goods or the services. So there is always a conflict. If the manager, if the finance manager understands the marketing department, and he sees that indeed there is a good result if the marketing department will have to implement such programs in order to increase the sale, and at the same time, if the department knows how to calculate the returns or the benefit that they could get out of those program, then it's for the finance manager to support their programs. So the purpose is to add value, and this is mainly through the sales and revenues of the corporation, of the business for that matter, be it that of the sole proprietorship, be it of the partnership or corporation. So you have to make sure that the return on the use of your assets and equities as are of higher returns, and this is through your um, the correctness of the activities that the company is uh, doing. I Okay, I think the syllabus is up to the consequences of having short run focus. But before that, there is a topic on the intrinsic value. So what is the intrinsic value in in uh, in a finance parlance? Practically speaking, the intrinsic value is the real value of the company, like simply uh, getting the net of the company's assets and liabilities. We come up with the net worth, or the the real value of the company. Another is that we have to look at, if we speak about the value of company in terms of it earning, what we call this, earning profit. The intrinsic value may pertain to the point where the 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 profit would be at zero. So what are the components of that? It is the line of the revenue, as much as, and the lines of variable cost and fixed cost are meeting. So there is no uh, there is no recognition of profit. So whatever is that point, that becomes an intrinsic value for the company. On the case of computing, the how much the how much the investors are getting from their investment or from their shares. So whatever the earnings per share of the company, it becomes to them the intrinsic value of their investment. In the case of stocks being traded in the market, the willingness of the buyers to buy and the willingness of the sellers to sell their their stock or their shares, that becomes the point or the price at which the there is a meeting of minds where there is a selling and buying that will happen, and that may become a what an intrinsic value of the company. Next is uh I think this is the last in the syllabus, the consequences of having a short run focus. um it would be very short discussion when we plan. We do not focus on the short term like only for 1 year. Neither we do not plan out for the next 10 years, although there is we can come up with a strategic plan of 10 years. But when we look at financial plan, it's good to have a 5 years financial plan. But no, that you only have to consider 1 year, or you have only a short run focus for your uh, plans, because you tend to have an immediate gratification, an immediate uh, profit making, and you do not know what will happen in the long run. So you have to also to plan out what will be happening up to the 5 years, and that is still manageable. Beyond that is no longer manageable to plan out for a longer than 5 years. Although for a for within that 5 years, you also have to consider those short run activities, because that will give you also a guide, a focus on what to do on a daily operation of the business. But do not focus on a um, very short run activities of your management in finance. Okay. After this, we will have a quiz based on this discussion. Be prepared for that quiz. And after the quiz, the group one will have to start with their first lecture. And mind you, the first lecturer becomes a benchmark. When I say becomes a benchmark, I would have to do some critiquing on how he or she performed in his lecture, because you have to realize whether to perform above her or just at par with her or him. It means that when I do a lot of critics yeah I do a lot of critiquing on his performance. You should be able to perform higher than what he has done, because the grade that you will be getting may be just the same with the first presenter who has a lousy presentation. On the other hand, I will be commending those who are good first presenter, and you may be making him as your benchmark, or you will be at par or better than his presentation. Okay, that's all. Good night.